Hi, everyone. Welcome back to Living Big in Dallas. Today, I'm going to show you why paying a high interest rate is actually optional. Yes, even in today's market. Because there are three powerful hacks buyers are using right now to lower their payments without waiting for rates to drop. Let's jump right in. Hack number one, seller paid rate buydowns. One of the most effective ways to reduce your interest rate today is through a seller paid rate buydown. This means you don't pay for it. The seller contributes toward lowering your rate, either temporarily or permanently. There are two big strategies here. There's a combination of temporary buydowns that affect the first and second, or first, second, and third year. The most impactful is a 3-2-1 buydown. This buys the present interest rate down 3% the first year, 2% the second year, and 1% the third year. At that time, you can refinance or go with the original rate, depending on the market. This is a huge opportunity and a huge savings for someone who knows their income will increase over 3 years' time. Here's an example. For a $1 million loan, let's say the present interest rate is 6.5%. For year one, your principal and interest payment will be $4,490.45 based on a reduced interest rate of 3.5% and an estimated savings of $1,830 a month. For year two, your monthly principal and interest payment will be $5,066 with a reduced interest rate of 4.5% and an estimated savings of $1,258 a month. And finally, the third year, your monthly principal and interest payment will be $56.77 with a reduced interest rate of 5.5% and an estimated savings of $642 per month. The permanent payment will be $6,320. The cost of this buydown is $44,722. Typically, a seller will cover this or a portion of this. There are many combinations of buydowns, including 2-1, 1-1, and 1-0. I have provided a link in the description of this video where you can go to an awesome calculator to figure your scenario. In fact, this calculator is handy for figuring payments, the cost of waiting to buy, refinancing calculator, prepay versus investing, and more. Also in this category is a permanent buydown. This is also something you can ask the seller to cover. In this scenario, a loan officer will need to give you the amount you'll need to permanently buy down the loan. Here's the part most buyers don't know. In many cases, the seller would rather give you a credit for a buy down than reduce the sales price. Why? Because a buy down improves your monthly payment, which is far more valuable to you long term. This gives you immediate affordability now and the chance to refinance later. Hack number two, builder incentives that reduce your rate. If you're open to new construction, this is huge. Builders, especially large DFW builders, are offering massive rate incentives right now for homes already built and on the ground. This is because they want to move inventory before the next fiscal cycle. Many builders partner with preferred lenders who can offer reduced interest rates, far below market, locked-in promotional rates. These are rate blocks bought down at earlier time to be used later. Credits toward closing costs, combined incentive packages, meaning rates and upgrades. And I've also seen builder-backed permanent rates 1 to 2% lower than standard market rates. Builders are offering temporary buydowns as well. So if you want to move in ready and a lower payment, new construction in Dallas, Frisco, Prosper, McKinney, or Salina might be your best shortcut. We are well versed in helping you obtain the best deal with the builder representatives, and we keep an inventory of where these houses are located on the ground, ready to move in. It's also an unknown fact that builder representatives always represent the builder and their best interests. You should have a realtor partner with you anytime you are looking for new construction. We know how to negotiate, how to get the extras, and the best part is you do not get a better deal not using a realtor. We are typically paid out of the builder's marketing budget, not the margin of the house. And we come to hack number three, assuming a seller's low FHA or VA loan. This one is a game changer, but you must know how to spot it. Some homes on the market have an assumable FHA or VA loan, which means you can take over the seller's existing mortgage at their interest rate. Keep in mind, this is only for owner-occupied houses, not investment houses. And guess what? Tens of thousands of FHA and VA loans were originated when rates were 2.75 to 4%. Imagine buying a house today, but with a 2021 interest rate. Now, you do have to cover the seller's equity up front, and this is the difference between the asking price and loan amount. And the assumption process can take longer, but the savings can be enormous. If you want me to check which homes currently qualify for an assumption, I can pull that list for you on an auto search. If this video adds value for you, please click to subscribe to my channel for more information about living big in Dallas. See you next time.